I'll tell you why. We've made a great deal of progress.
All right, we're listening to Jerome Powell.
Through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways.
Rates got cut today. We're
late last year.
So federal funds rate got cut.
Is steadily coming down now.
25 basis points.
Than we might like, but it has now come down substantially, and it is making progress.
So we're listening in on Jerome Powell's testimony.
Recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further.
Turn him up a little bit.
You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year.
We got the 10-year Treasury. Let's see where that's trading right now.
You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything.
10-year Treasury is up 7 basis points on the Fed rate cut to 5.25 to 4.5. Quarter point decrease. So 10-year Treasury yields increasing on that news.
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts.
Probably Trump's tariffs.
To your question,
of course, they're going to be inflationary unless they can set up a regulatory environment to create some of the things that we have done offshore. You're not going to be able to get certain products, so those products are going to have much higher prices. So it's important that Trump creates a regulatory environment
where
that's conducive to that.
Tighter policy, in part, in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation.
Anybody's watching this, do you have any comments? I'd love to hear.
How much of this was accounting for inflation data that was coming in, and how much
of some comments
expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year. That inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the
I think we're right around 5.75, 6 5/8 right now.
Right?
With a higher 10-year Treasury, we may be a little bit higher for net deals.
2024 so far than we had expected.
If you or your clients are involved in any kind of 1031 at the end of the year, give me a ring. Let's put a deal together.
In the SEP, you'll see that.
Just call me on my cell.
I think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I'd say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. And the point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And so that may have affected some of the people. But as I said, there's
Trump's
a
tax
range of approaches.
decrease proposition will
If I could follow up on
definitely
that, you mentioned the risk and uncertainty
be
indexes
a
toward the back of the document. The
increasing
upside
path
risk
to
to inflation
rate.
jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly
where the stock
a large
market is
factor
right
in
now.
people's thinking. I can tell you that might be the single biggest
So
factor. Is
447
inflation
on the
once again
10-year Treasury.
underperformed relative to expectations. It's still,
I think
gonna be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. To as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter
stock market
of 2023. Nonetheless, as we go
down
forward, we're going to want to be
355 right
seeing
now.
further progress on bringing inflation down.
Stock market's
And
down
keeping a solid labor
355. So I guess the stock market didn't like his. Here. Oh, there we go. We're back.
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point there's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect.
One thing Trump said he's going to do is eliminate a lot of the regulatory environment for banks. So that means probably more lending.
All of us have, each of us.
Kind of like Ronald Reagan did,
It
and
puts us in position when we finally do
George
see what
Bush. So
the actual policies are to be.
That'll be definitely stimulated to real estate.
More careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
The main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know
Now it's
whether
down
the last
359.
episode is or is not
See where the 10-year treasury
model
is
for
right
what
now.
happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since
10-year
then.
treasury
That
447
may
right
have
now.
effects. I don't know. I just think we need to take our
447
time,
on the
not
10-year.
rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some.